Welcome to the deep dive. We're here to sift through that whole stack of sources you sent over, really boil it down to what you actually need to know.
Actionable insights, that's the goal.
Exactly. And today, we're tackling a really interesting one. A company that's gone through this, almost unbelievable change. Tilray Brands, ticker TLRY.
Yeah, Tilray. For years, they were basically the name, the poster child for, the pure play cannabis dream.
Totally. But things look very different now. Our source material, just so you know, is current right up to the close on October 31st, 2025. Share price then was $1.34.
And that price, $1.34, that's where the market's sitting right now. But the company itself, it's fundamentally different from just a few years back.
So that's our mission today, right? For you, the listener.
Right. The big question is Tilray still that high-risk, high-reward bet purely on U.S. cannabis legalization? Or has it actually pulled off this pivot? Has it become something genuinely new, like a diversified global CPG company, consumer packaged goods?
And the sources, they point to this huge moment. Tilray just posted its first quarterly net profit in, well, years.
Which sounds great on the surface.
But here's the kicker, the real hook for this deep dive, that profit. It wasn't mainly driven by cannabis sales. Not even close.
It came from this really deliberate, pretty aggressive acquisition strategy. It's quietly turned Tilray into, get this, one of America's largest craft brewers.
Crazy, right? So we're going to unpack this kind of weird hybrid identity, dig into the business lines, the management thinking, the financials, see if we can figure out the intrinsic value here.
And what we found looking at the experts is this massive disagreement. Price targets are all over the place, huge range.
But fascinatingly, that $1.34 stock price, it lands pretty much smack dab in the middle of all that disagreement.
Yeah, it's like the market's perfectly balanced on this knife edge, weighing these incredible opportunities against some pretty severe risks that come with changing so fast.
So by the end of this, you should have a much clearer picture. You'll be able to decide which side of that risk-reward fence makes sense for you.
Makes sense.
Okay, before we properly dive in, just a quick call-out. If you find this useful, please do like and subscribe to the Stock Analytics AI YouTube channel. It really helps us out.
Yeah, definitely helps.
And remember, for just $4.99 a month, members get access to our big playlist. We've got, 500 deep dive videos covering all the S&P 500 stocks.
That's a lot of content.
It is. And next up, just for members, we're tackling the NASDAQ 100. Plus, members can also suggest stocks for us to cover. Just drop the ticker in the comments, and we'll get on it. We really do appreciate those suggestions.
We do. It helps us know what you're interested in.
Okay, then. Let's get into this transformation, starting right at the foundation, the business itself.
All right. Chapter 1. Business analysis.
So first things first, we absolutely have to talk about this identity shift. Tilray very consciously moved away from being just a cannabis company.
Right. Towards this diversified CPG model, consumer packaged goods.
And you said it wasn't just about ambition, right? The sources suggest it was almost a necessity.
Yeah, think about it. The pure play cannabis sector, especially in Canada, it's got incredibly high regulatory risk. And the price volatility, it's just crushing. So diversification was a way to mitigate that, to de-risk the business.
Okay, and that de-risking decision, it shows up clearly in the numbers, doesn't it? Let's look at Q1 fiscal year 2026. This is where the story really flips.
It really does. So total revenue for that quarter, $209.5 million. But when you break that down, well, the old view of Tilray just vanishes.
Yeah, get this. Their global cannabis segment, the thing we all associate with the ticker.
Yeah.
That only brought in $64.5 million, just 31% of the total revenue.
Only 31%. That's a huge change. It means nearly 70% of their top line is now coming from non-cannabis cultivation segments.
Wow, 70%.
And that 70% is really important because it brings, stability, or at least more stability. The biggest slice isn't even North American.
Right. It's distribution in Europe, CC Pharma.
Yeah.
$74 million, or 35% of the total revenue.
Yeah. Yeah, CC Pharma, that's a pharmaceutical distribution business. Highly regulated, yes, but it generates pretty stable, decent margin revenue selling medical products across the EU. It's a totally different ballgame from Canadian weed.
That stability from CC Pharma, you really need to grasp that. Because when Canadian cannabis margins are getting squeezed hard by competition, by the illicit market, that distribution segment is like a reliable anchor.
Exactly. Then you've got the beverage alcohol piece in the U.S. That's $55.7 million, about 27%. And the wellness segment, Manitoba Harvest, hemp foods and CBD, that's smaller, $15.2 million, around 7%.
So stepping back then, the big takeaway here.
The key takeaway is this. If you're valuing Tilray only on the hope of U.S. federal cannabis legalization, you're fundamentally missing the boat. You're ignoring, like, 2/3 of the actual business it's operating right now.
And generating revenue in different, arguably much more stable markets. It's a genuine hedge.
It is. Now, that doesn't mean cannabis isn't important still. Let's look at market position and scale. Despite the pivot, they are still the #1 licensed producer by revenue in Canada.
Okay, so they still dominate the world's largest federally legal market.
Mm-hmm.
That scale must give them some advantages, right? Cost structure, supply chain.
It does, yeah. Even if that Canadian market is facing headwinds, being the biggest helps. But strategically, the real focus, the center of this diversification, is the U.S. foothold.
The non-cannabis foothold.
Right. Through buying up companies like Sweetwater Brewing, Montauk Brewing, and then those legacy brands like Red Hook, Widmer Brothers, Tilray is now the 4th largest craft brewer in the entire United States.
Okay, unpack that for us. Why is being the 4th largest craft brewer so critical? It's not just about selling IPAs, is it?
Not at all. I mean, take Sweetwater. Hugely popular, especially in the Southeast. They have that kind of counterculture 420-friendly vibe already baked into the brands.
Right, I know the brand.
So Tilray bought immediate relevance, yeah. But more importantly, they bought a sophisticated existing distribution network, one that crosses all 50 state lines. Something a pure cannabis company just cannot do legally right now.
Ah, okay. So that's the strategic value proposition then. It's this massive hedge.
Exactly. Management's goal here is to be a leading global CPG company across wellness, beverages, and cannabis. So for you, the investor, what does it offer? It offers exposure to that huge potential of global cannabis. They're talking $100 billion by 2030, right?
Yeah, massive numbers being thrown around.
But it hedges the wild volatility of getting there with these established proven revenue streams, U.S. craft beer, European pharmaceuticals, things that are making money today.
Okay, and speaking of volatility, we really need to spend a minute on the regulatory situation because it just completely underscores why they made that beverage pivot.
Absolutely. In the U.S., cannabis is still a Schedule I substance federally. And that's not just some minor inconvenience. It creates these crippling financial problems for cannabis companies.
The big one being 280E, right?
Oh, heck.
IRS code 280E.
That's the killer.
Yeah.
Yeah. So what 280E does is forbid companies dealing in Schedule I substances from taking standard business deductions.
Okay, make that practical for us. What does that actually mean?
Okay, so imagine a normal company, say a brewery. They sell beer. They spend $100 on marketing, rent, salaries for the office staff, right? Normal operating expenses.
Sure.
They can deduct pretty much all of that $100 before they calculate their taxable income. Cuts their tax bill way down.
Makes sense.
But now, take a U.S. cannabis company selling, legal weed in California. Under 280E, they might only be allowed to deduct expenses directly tied to the cost of goods sold. So growing the plant, maybe packaging it.
So all the other stuff, marketing, the CEO's salary, the rent for the dispensary.
Largely non-deductible, which means their effective tax rate can just skyrocket. We're talking over 70% in some high-tax states. It makes achieving real, legitimate profit incredibly difficult, almost impossible, no matter how well you run the business itself.
Wow. Okay, so that regulatory nightmare, management saw that coming.
Seems like it. And that's why acquiring these cash-flowing, federally legal U.S. beverage assets looks like, well, brilliant foresight now.
So the beverage pivot wasn't just about beer sales today. It was more like a Trojan horse strategy.
You could definitely see it that way. These breweries, they provide immediate, legitimate revenue, sure. But critically, they provide that physical distribution network. Already licensed, already operating, across all 50 states.
Which means if U.S. federal reform actually happens.
If it happens, whether they deschedule cannabis or pass banking reform, like the SAFE Act, Tilray is just uniquely positioned, they could, theoretically, immediately start leveraging that existing infrastructure to launch THC-infused beverages.
Giving them a massive head start over their Canadian cannabis rivals would be scrambling to build a U.S. presence from scratch.
Exactly, starting from zero. While Tilray potentially hits the ground running.
This whole landscape also seems to create these huge barriers to entry, doesn't it? Which probably favors the big guys like Tilray.
Absolutely. You've got incredibly high financial barriers. Just getting licenses costs a fortune, plus massive capital needs. And then you have what we call regulatory silos.
Explain those silos.
Well, because cannabis is federally illegal, the U.S. market is all broken up, fragmented. Each state is basically its own little island market with its own rules, its own licensing. It's incredibly complex.
So navigating that takes serious scale and resources.
Right. And that complexity, that high capital requirement, it just naturally favors companies that can operate at scale across different regulated areas. Like Tilray's diversified structure seems better suited than, say, a small startup trying to crack into multiple states.
Okay, let's talk competitive edge then. It sounds like pure scale is a big part of it.
It really is. Look at their trailing 12-month revenue, $821 million. Now compare that to Canadian rivals. Aurora Cannabis, $247 million. Canopy Growth, $226 million.
Wow, yeah. Tilray is just dwarfing them on the top line.
And that superiority is a direct result of the diversification strategy. It's the beer and the pharma distribution padding those numbers.
And beyond just revenue, it's the actual assets they own, right?
Yeah, that unique combination. Very few competitors, maybe none, have both the EU GMP certified facilities in Europe, which you absolutely need for exporting medical cannabis there, and this extensive federally legal U.S. CPG footprint that can distribute regular consumer products coast to coast.
Okay, this whole strategy, heavy M&A, global footprint, different industries. It sounds like it needs a very particular kind of leader at the helm. Does Irwin Simon fit that bill?
Well, let's dive into that. Chapter 2, Management Evaluation.
So when you evaluate the leadership, it really does seem to start and end with the CEO, Irwin D. Simon. His background basically is the strategy, isn't it?
It really is. He's not a traditional cannabis exec, not at all. He's a seasoned CPG veteran. Most famously, he founded the Hain Celestial Group.
Right, the natural foods company. Big one.
Huge. He grew it into like a $3.5 billion natural products company, and his specialty was building this house of brands.
Okay, so he's taking the CPG playbook.
Exactly. Aggressive M&A, diversification, building brands. He's applying that exact playbook to the, let's face it, chaotic cannabis sector.
His philosophy seems to be about adapting proactively, right? Not just waiting around for politicians.
That's the key. Instead of just hoping for U.S. legalization, he went out and bought diverse revenue streams. Then he implemented aggressive cost-cutting, used traditional business discipline to push the whole organization towards profitability.
And that adaptation, that's the turnaround story we're seeing now. It led to that first ever quarterly net profit in Q1 fiscal 26.
Right. It suggests that the CPG playbook, focusing on cost control, revenue diversity, it seems to be working, at least in the short term. It's stabilizing what was, frankly, a wildly unprofitable company for a long time.
But let's look critically at capital allocation, because that really tells you what the investment thesis is here.
Okay, so where's the money going? Almost entirely towards strategic acquisitions, buying things to build out that U.S. infrastructure and revenue base.
Like the Montauk Brewing purchase, the Hexo deal in Canada, buying those 8 beer brands from Anheuser-Busch.
All examples of that. It's a buy-to-grow strategy, focused on getting bigger, gaining market share.
Which means, for shareholders right now, don't expect dividends or buybacks.
Nope. The company doesn't pay a dividend, no share buyback program. If you're investing in Tilray, you're betting entirely on the future stock price going up, betting on successful execution of the strategy, and, well, eventually hoping for that U.S. liberalization catalyst.
But there's some significant baggage they're carrying from all this buying, isn't there? Talk about return on invested capital, ROIC.
Yeah, ROIC. Historically, it's been really bad, substantially negative for years. And ROIC is like the fundamental measure of how effectively management is using capital.
So negative ROIC means?
It means the money they're spending mostly on these big acquisitions has actually been destroying value historically, not creating it. That's a harsh reality they need to overcome.
And that leads straight to this huge risk sitting on their balance sheet, goodwill.
Oh, yeah. $1.3 billion in goodwill. That's a massive number.
Explain goodwill for us quickly. What is that $1.3 billion representing?
So goodwill is basically the premium a company pays when it buys another company over and above the fair market value of the tangible stuff, like buildings or inventory.
So it's like an accounting plug number.
Right.
Representing
thicker.
Future value, brand value,
Yeah.
synergies.
Exactly. It represents the perceived future value from things like the brand name, customer lists, expected synergies. But it's intangible. And here's the risk. if those acquired assets don't perform as expected.
If Sweetwater sales disappoint or the synergies with Montauk don't materialize.
Then Tilray has to write down that goodwill, take an impairment charge. And we saw just how bad that can be back in fiscal year 2025. They took a staggering $2.18 billion goodwill charge, wiped out a huge chunk of shareholder equity.
So management is trying to execute this turnaround while that $1.3 billion goodwill risk is just hanging over them. That's like walking a tightrope.
It absolutely is. That Q1 profit, a really necessary first step. But they have a long way to go to prove that this M&A strategy is actually creating sustainable value and not just inflating revenue while hiding future impairment bombs.
Okay, so we understand the strategy, the leadership CPG approach, and the big risks involved. So let's look at the hard numbers now. Is this turnaround actually showing up in the financials?
All right, Chapter 3, Financial Analysis.
Okay, key metrics. We know the market cap is around $1.5 billion. Let's dig into that revenue trend again. Fiscal year 2025, revenue grew 4% year over year to $821.3 million.
Right, and the immediate question you have to ask is 4% growth really enough? Enough to justify the huge costs of all that M&A, the integration headaches, the goodwill risk?
And crucially, that 4% growth, it wasn't organic, was it?
No, not really. It was entirely bought. It came from 19% growth in that beverage segment, the breweries they acquired. And that growth successfully masked or offset a decline in their original core cannabis segment in Canada.
So the diversification strategy is working in the sense that it's propping up the top line, but it's also hiding some underlying pressure in the original business.
Precisely. Now, let's get to the big news, the profitability inflection point. This is what caught everyone's attention. Q1 fiscal 26, they reported positive operating income, $2.1 million.
Which is a massive swing from the year before, right?
A huge reversal. They lost $36.6 million on operations in the prior year's quarter.
And that didn't just happen by accident. How did they pull that off?
Managerial discipline. Plain and simple. They slashed operating expenses by 42%. That's Irwin Simon's CPG playbook in action. Aggressive cost-cutting in production, SG&A selling, general administrative costs.
And that disciplined cost management led to the headline number.
The big one. Tilray reported its first ever quarterly net profit, $1.5 million in Q1 fiscal 26. Now, okay, $1.5 million isn't a huge amount on $200 million in revenue, but symbolically.
Symbolically, it's huge.
Yeah.
For a company and a sector, that's just bled red ink for years.
It signals a potential watershed moment. Maybe sustainable profitability is possible, but...
There's always a but.
There's always a but. We have to flag the significant margin pressure. Gross margins, that's revenue minus the direct cost of goods sold, actually compressed. They went down across all the key segments in that same positive Q1.
Oh, interesting. So even while reporting a net profit, their core profitability per unit sold was weakening.
Seems like it. Cannabis gross margin fell from 40% down to 36%. Beverage gross margin fell from 41% to 38%.
What does it imply? Why would margins be shrinking?
It suggests that even with their scale, they're likely facing tough competition. Intense pricing pressure, maybe rising input costs like ingredients or labor. It makes achieving sustained profitability much harder if your margins are constantly getting squeezed.
So they prove they can cut overhead costs, but maybe they haven't yet proven they have strong pricing power in their markets.
That's a fair assessment. Now, let's look at financial stability and cash flow. The 5-year history here isn't pretty. Consistent negative free cash flow. Meaning, historically, the business hasn't generated enough cash on its own to fund its operations and investments.
They've been burning cash.
Consistently. For example, negative $120 million in free cash flow in fiscal 2025. However, again, Q1 fiscal 26 showed a dramatic improvement. Cash used in operations narrowed significantly to only $1.3 million.
So almost break even on cash flow from operations.
Almost. And arguably, getting close to cash flow break even is even more important than that small net profit number. It signals real improvements in operational efficiency. They're getting closer to being self-sustaining.
And the balance sheet itself, does it look strong enough to support this M&A heavy strategy?
It looks pretty robust right now, actually, which it needs to be. They have a low debt-to-equity ratio, around 0.17. That's good. And strong liquidity, their current ratio is 2.62.
Meaning their short-term assets comfortably cover their short-term liabilities.
Right. Current assets of $701 million versus current liabilities of $267 million. That gives them flexibility and looks good to lenders.
Okay, finally, let's touch on valuation. How is the market pricing this complex beast?
Well, price to earnings, PE ratio is totally meaningless here because of that history of losses. Can't use it. So analysts tend to look at price to sales, PS. Tilray's PS ratio is about 1.83.
How does that compare to, say, other Canadian cannabis players?
It's a premium. Aurora Cannabis, for example, trades at a PS of about 1.33.
And why does Tilray get that premium valuation on sales?
Analysts point directly to the diversification. The stability provided by those non-cannabis revenue streams, CC Pharma in Europe, the U.S. beverage platform. The market is essentially saying Tilray is less risky than its pure-play cannabis peers because of this diversification.
Okay, that's relative valuation. What about intrinsic value, trying to figure out what it's really worth?
Yeah, using a discounted cash flow model, a DCF. Now, you have to be conservative here, given the risks. The sources suggest an estimated fair value range of $1 to $1.75 per share.
That's a pretty wide range, $1 to $1.75. Why so wide?
It has to be wide because the inputs are so uncertain. You need to use a high discount rate, maybe 12% to 15% to account for all the regulatory risk and execution risk. And then you need to project future growth.
Which is tricky.
Very tricky. The models might assume, say, 5% to 10% long-term revenue growth, which sounds okay, but it's actually below the projected 18% annual growth often quoted for the overall global cannabis market. So it's baking in some conservatism. That wide $1 to $1.75 range really just reflects the huge uncertainty, especially around the timing of U.S. legalization.
Okay, that wide range and the current price sitting right in the middle sets the stage perfectly. Let's move into part two. How is the market, how are insiders actually viewing this massive shift?
All right, Chapter 4, Market Sentiment.
This is where it gets really interesting, looking at analyst perception. You mentioned the disagreement earlier.
Yeah, Wall Street is just deeply divided on Tilray. It perfectly mirrors that fundamental uncertainty. Will the CPG diversification actually work out long term? Or will the M&A risks, the goodwill, come back to bite them?
And the price targets reflect that division.
Right, absolutely. The range is just enormous. The low target in the sources is 0.85 cents, basically saying, we don't buy the turnaround yet, the risks are too high.
Okay, $0.85 and the high end.
The high target goes all the way up to $2.50. Those analysts are clearly betting heavily on successful integration, continued cost control, and probably some kind of near-term U.S. catalyst happening.
Wow, $0.85 to $2.50. That's almost a 300% difference between the lowest and highest expectations.
Exactly. And that huge gap is probably the clearest signal you can get. This is a high-risk, high-reward stock. The outcome feels very binary. If this turnaround sticks and they execute well, maybe the stock flies towards like $2.50. If they stumble on integration or U.S. reform stays stalled, it could easily drift back towards those lows.
How's the general media tone been, especially since that Q1 profit news?
Overwhelmingly positive since that announcement on October 9th. The narrative in the press has definitely shifted. It went from, struggling Canadian pot stock to more of a successful CPG turnaround story.
And news about international expansion probably helps that narrative too, like selling beer in Japan or medical cannabis in Panama.
Yeah, it reinforces the idea of a global CPG player, not just a Canadian cannabis company anymore.
Okay, let's look at some technical indicators. Short interest. Are people still betting heavily against the stock?
Well, short interest is still significant, around 9.42% of the float. That's not insignificant, but it represents a really substantial decline. Back in June 2025, it was over 20%.
So a lot of shorts have covered their positions, taken their profits or cut their losses.
Seems like it. As the financial news got better, the bears seem to be retreating somewhat, reducing that downward pressure on the stock price.
And where's the stock trading relative to its moving averages? The price is $1.34 now.
Okay, so technically $1.34 is actually trading just below its 50-day moving average, which was around $1.41.
Which is usually seen as a short-term bearish signal, right? Maybe some consolidation after the earnings pop.
Could be, yeah. Profit-taking, consolidation. But if you zoom out, look longer term, the stock is still significantly above its 200-day moving average. That's way down at $0.84.
Okay, so the short-term trend might be a bit weak, but the longer-term trend is still clearly bullish, pointing upwards from those lows.
Exactly. The market seems to acknowledge that the strategic pivot, the cost cuts, they've successfully pulled the company out of that deep hole it was in. They've established a new, higher floor, even if there's debate about the ceiling.
All right, let's shift gears slightly. Who actually owns this stock? Because the ownership structure can tell you a lot about potential volatility.
Good point. Chapter 5, ownership structure.
So institutional ownership,
Yeah.
big funds, pension plans, Are they heavily involved?
Actually, no. Institutional ownership is relatively low, somewhere around 10% to 12%. And who owns that slice? It's heavily dominated by thematic cannabis ETFs.
Like funds specifically designed to track the cannabis sector.
Exactly. Companies like Taroso Investments amplify ETF trust. And then you also see high-frequency trading firms like Citadel, Susquehanna holding positions.
What's the significance of that kind of ownership base? Lots of ETFs and trading firms, not many long-term institutions.
Well, it introduces a major volatility factor. When a stock is mostly held by these thematic ETFs, big price swings can happen just because money is flowing into or out of the entire cannabis sector, regardless of Tilray's specific performance that day.
So if some bad regulatory news hits the U.S. cannabis market in general, Tilray could get hammered, even if, say, their Sweetwater beer sales are hitting records.
Precisely. The stock price can become disconnected from the company's own operational fundamentals because it's moving with the sector tide. Makes it riskier day to day.
Okay, but what about insiders, management directors? Are they buying or selling? What's the confidence signal there?
This is maybe one of the most interesting points in the ownership section. Overall, insider ownership is very low, less than 1%. And historically, the trend had been net selling by insiders. Not unusual for a company that's issued a lot of stock.
Okay, so low ownership, past selling, doesn't sound great.
But the sources highlight this really crucial cluster of open market purchases that happened in late July and early August 2025.
Open market buys, meaning they use their own money to buy shares on the exchange, not just getting options or grants.
Exactly. And who was buying? CEO Irwin Simon made a pretty sizable purchase, 165,000 shares, and the CFO, Carl Merton, and the Global General Counsel also bought shares around the same time.
Okay, insiders buying is usually a good sign, but what about the timing? You said late July, early August.
That's the key detail. Those purchases happened weeks before the company publicly announced that first ever quarterly net profit on October 9th.
Ah, so they were buying with their own cash before the positive earnings news hit the market.
Exactly. It signals really strong conviction. Management wasn't just talking about a turnaround, they were putting their personal money where their mouth was, based on the internal numbers they were seeing before the rest of us knew.
That suggests they genuinely believed the cost-cutting and the diversification were working and that the results would be good.
It strongly implies that, yes, that kind of pre-earnings insider buying, especially by the CEO and CFO, is a powerful, positive signal for you to consider. It shows real skin in the game.
That is a compelling point. It definitely adds weight to the bull case. Okay, this seems like a good moment to formally lay out all the pros and cons we've discussed. The SWOT analysis.
Makes sense. Chapter 6, Risk Assessment. SWOT.
All right, let's start with the strengths. The core of the bull case for Tilray. Number one has to be the diversification, right?
Absolutely. Having these genuinely different revenue streams, beer, pharma distribution, cannabis, wellness, they don't all move together. That provides a buffer.
Strength number two. Market dominance. There's still #1 in cannabis, #1 in Europe's medical market, and, crucially, #4 in U.S. craft brewing. That scale matters.
And third, that CPG leadership. Having Irwin Simon, someone with a proven track record in building consumer goods companies, applying that discipline to this messy sector, that's a strength.
Okay, now for the flip side, the weaknesses. The heart of the bear case. Number one is just the history.
Yeah, you can't ignore it. Years and years of massive net losses, consistently burning cash. One small profitable quarter doesn't automatically erase all that. Sustainability is still very much unproven.
Weakness number two, that margin erosion we talked about. Gross margins shrinking across the board recently suggests underlying pressures are still very real.
Definitely a concern. And then there are those two huge structural weaknesses we discussed. First, integration risk.
Right, trying to manage this sprawling global empire they've built through rapid M&A. German pharma, U.S. beer, Canadian cannabis. It sounds like an operational nightmare just waiting to happen. Huge complexity.
It's a monumental challenge, and that complexity brings us back to the second structural weakness, goodwill risk.
That $1.3 billion hanging over the balance sheet, always at risk of a write-down if any of those big acquisitions underperform. We saw what happened in FY25 with that $2 billion charge. It's a constant threat.
Huge threat to the balance sheet integrity. Okay, so those are the internal weaknesses. What about the opportunities, the potential catalysts that could really drive the stock higher?
The big one, the elephant in the room, U.S. federal reform.
Without a doubt. That's the single biggest potential catalyst. If the U.S. removes cannabis from Schedule 1 or even just passes safe banking.
It removes that crippling 280E tax burden. It gives them access to normal banking services. And crucially, it unlocks that existing U.S. beverage infrastructure for THC products almost overnight. Game changer.
Total game changer. Beyond the U.S., there's also significant international growth potential. Germany's medical market is apparently booming since they changed the rules in 2024.
And they're expanding into new markets too, right? Like Panama.
Yeah, expanding medical exports, maybe eventually recreational in some places, lots of growth potential outside North America.
Okay, so big opportunities. But finally, we have to consider the threats. Those external factors, often outside of management's control.
Top of the list has to be continued regulatory uncertainty. What if U.S. reform just stalls indefinitely? Or what if Canada decides to slap higher excise taxes on cannabis, squeezing those margins even more?
Big risks. What else?
Competition. It's fierce. You've got intense price compression from other licensed players trying to gain share, and you're constantly battling the low-cost illicit market, which is still huge. That puts immense pressure on pricing.
And then just macro factors, right? Things affecting everyone.
Yeah. Inflation pushing up costs for ingredients, packaging, labor, squeezing those already thin margins. And if interest rates stay high, it makes future acquisitions more expensive, increases the cost of capital for growth, all potential headwinds.
Okay. Strengths, weaknesses, opportunities, threats. That lays it all out pretty clearly. This brings us right to the conclusion, tying it all together.
All right, Chapter 7. Conclusion.
So let's quickly synthesize the findings. First, the bull case summary. Why might you be optimistic about Tilray?
Well, the pivot to that diversified CPG model, it's clearly working on the top line. It's generating substantial non-cannabis revenue. That provides a real hedge.
And that first profitable quarter, Q1 FY26, it signals a potentially critical turning point, shows the cost-cutting is having an impact, maybe moving towards financial self-sufficiency.
Plus, they hold these defensible market leadership spots globally, Canada, Europe, U.S. craft beer. And you have that strong management conviction shown by that strategic insider buying before the good news hit.
Okay, that's the bull case. Now the bear case summary. Why might you be pessimistic?
Well, decades of huge losses really overshadow one tiny positive quarter. Sustainability is just not proving yet, especially with those shrinking gross margins.
And the core cannabis revenues actually declined. The overall growth was entirely bought through acquisitions, which might be masking underlying problems.
And at the end of the day, future blockbuster success still seems highly dependent on U.S. regulatory action. That's unpredictable. It's entirely outside their control. If legalization keeps stalling, the biggest catalyst remains out of reach.
So if we bring this back to the valuation, that intrinsic value range we talked about, $1 to $1.75 per share.
Right. And the current share price, around $1.34, falls smack bang in the middle of that wide range.
What does that tell us?
It tells us the market is essentially undecided. It's stuck. It's fairly balancing the huge potential of this diversification strategy and the recent glimmer of profit against the monumental execution risk, that scary goodwill balance, and the long, ugly history of destroying shareholder value.
So for you, the listener, the decision comes down to this. Do you believe that recent profit marks a genuine, sustainable new trend? Is this the start of something that justifies a valuation closer to that $2.50 analyst high target?
Or do you think it's just a temporary blip? A brief moment of relief before the complexities of integration bite, or before the next major goodwill write-down hits the books. That's the fence you need to decide which side you're on.
And this leads us perfectly into our provocative final thought, something to really chew on after this deep dive.
Okay, let's hear it.
Given that the whole U.S. beverage strategy, buying breweries like Sweetwater and Montauk, is explicitly designed to position Tilray for THC-infused drinks after U.S. legalization, maybe we should rethink who their real long-term competitors are.
Go on.
Explore this idea. Maybe Tilray's future isn't really about battling Canopy Growth or Aurora anymore. Maybe the real competition, the real end game for their CPG strategy, is competing against giants like Coca-Cola, PepsiCo, or Anheuser-Busch InBev in this entirely new category of wellness and functional beverages, which might include THC down the line.
Huh. So less pot stock, more future beverage giant, competing with Coke and Budweiser in the cannabis-infused space.
Exactly. Is it the true potential prize locked inside this CPG pivot? Something to think about.
That definitely reframes the long-term picture. A much bigger pond to swim in, but with much bigger sharks, too.
Indeed. Well, we hope this deep dive into Tilray Brands has given you a clear, structured way to understand this really significant strategic shift, from cannabis pure play to potential CPG giant.
Remember, if you have a company you want us to tackle, drop the ticker in the comments. We appreciate the suggestions.
We do. And just the standard reminder, this analysis was generated by an AI system. It's for educational purposes only.
Yep, definitely not financial advice. Please do your own research or talk to a qualified financial advisor before making any investment decisions based on this.
Absolutely. Thanks again for sharing your sources with us and letting us guide you through this today. We'll see you on the next deep dive.